Good evening. Firstly, I'd like to thank you all for attending our personal financial fitness coaching webinar this evening. For those that don't know me, my name is David Evers. I'm the Managing Director here at Adviceco. I'm also a Senior Wealth Advisor and have been with Count for over 20 years. A Designated Financial Planning Specialist with the Chartered Accountants, SMSF Advisor, as well as an SMSF Registered Auditor. So I've been in the financial services game for a fair period. I've also had the opportunity to work with a number of experts and highly qualified professionals. And with me tonight is Christine, who happens to be one of those said professionals. So I must say an apology for Ed. Ed was is one of our advisor team and our up-and-coming young gun. But unfortunately, Ed has been called ill in this new crisis that we face, and we're waiting Ed's COVID test. So our fingers are crossed for him, but I was thankful that Christine could fill in at short notice for Ed in tonight's presentation. But Ed, I believe, is listening in. So Ed, we're thinking of you and good luck with the test. So getting started with tonight's presentation, and tonight's presentation is only stage one. There is an opportunity for those that aren't already working with us to take the next step in terms of their financial fitness coaching journey, but we'll have a little bit more about that to say about that a little bit later. Okay, tech issue there for 2 seconds. Okay, so effectively that's myself and Ed. A little bit about us. Effectively, our business is a truly integrated financial services advice business. We have 28 professionals, and we operate in both the accounting and financial services field. So we are experienced chartered accountants, business advisors, so we do understand tax planning and basically growing and improving and protecting clients' business wealth. We're also qualified financial planners, so we understand about cash flow and maximising the opportunities that flow from that cash flow. And we are also involved in coaching, both in the financial and the business world, which means effectively we can help our clients impart knowledge and make sure that they're on track to achieving their goals. Now, it wouldn't be an accountant's presentation without having a disclaimer of some description, but I must stress at the outset, tonight's presentation is not about products or specific investments. Unfortunately, the way the presentation works, I can't take into account your own individual circumstances, but tonight we've got our financial coaching hat on, and we're really discussing general principles and concepts that can be applied to each and every one individual's own circumstances. So we're going to help you give you some tools and strategies tonight, which I'd like you to sit back and consider how they can be used and assist you in doing what you need to do to achieve your financial goals. Not what I see for you, but what you see yourself. So tonight is all about you, and I would encourage you to make notes and record some key learnings as you're going through. We do try to make these presentations as interactive as we can. In this virtual world, that becomes a little bit more difficult than what it is when we're normally holding our workshops in a boardroom. But if you do submit any questions through the chat facility, which is going to be at the bottom of your screen, we'll do our best endeavours to answer those at an appropriate time in the presentation. So feel free to ask the questions. If by reason we don't manage to get through because there's too many questions or we run out of time, please be assured that we will get back to your question following the presentation if need be and give you an appropriate answer. So I do encourage you to participate and to interact as much as you possibly can, because that's what we find gets the right outcome when we're running these sessions. So in a simple sense, tonight's about considering where you actually are now and planning for where you want to be it in 5, 10 or 20 years' time. So it may well be that you're thinking about starting a family. It's one of your goals, providing for children's education. Perhaps there's travel that you're looking to do, or to should be in chemtrail today, maybe in New South Wales perhaps, but effectively maybe it's building a retirement nest egg that you're looking to retire comfortably with. Whatever your goals are now, it starts with basically you're taking stock of where you are now and actively considering where you want to be in the future. So by doing that, this is the first step we can help you or coach you, if you like, to take control of your own circumstances. So whatever your dreams and aspirations are, money will absolutely play a role. So part of tonight's presentation, or a fair part of tonight's presentation, is to basically drill into ways that you can help control those decisions you're making in that area and coaching you to get a better outcome. So first point I'd make about what's the secret to success is there's probably no single secret to success. There's no silver bullet that's magically going to solve all problems. But there is a combination of three things that we would suggest here. There's the right mindset. It's making sure that we've got the right strategies that effectively implement the correct mindset, and basically making sure that you're selecting an appropriate time frame. In other words, setting some goals that actually achieve what you're looking to in a specific timely manner. So to have an effective mindset, the first thing is you must set clear goals. And what's a clear goal? In our coaching sessions, we focus on setting SMART goals, and SMART goals are goals that are specific, measurable, achievable, realistic and timely. So basically, if the goal is not having and broken down into those components, then effectively we would not consider that to be a SMART goal. So SMART goals need to be disciplined, and you need to be consistent with the way to actually moving towards implementing those. And that's what the coaching process does. It helps people get on track with that discipline and keeping them honest and accountable, to be frank. So part of those strategies are all underpinned by what I would say to you, setting a budget. So setting a budget basically puts a line in the sand for what you expect that you're spending, and then can show what capability you have to set aside some money to reach your medium-term and your long-term goals. If you don't set the budget in the first place, you can't manage whether you're on track and whether you are going to meet your targets. What we find typically is the best tip we can do in that space is if you set your budget and you set a good realistic budget, then you can set up a special account where actually you can start making sure that you're saving to that other account. Have the money deducted from your salary. Set up a separate bank account. Have a periodic payment that can actually transfer it. And know that if you are having to tap into that savings account, that effectively you are reducing what you had set aside, or what you believe you were able to set aside to meet your long-term and your medium-term goals. So once you've started to consider, okay, we're setting aside capital and we're making decisions to achieve our goals, well then how long do we need to achieve those goals? Whether it be short-term goals, which might be 1 or 2 years, medium-term goals, which are typically 3 to 5 years, or long-term goals, which would be 5+ years. So basically, the sooner you start planning to achieve those goals, and the sooner you've got a realistic plan, a budget to help you move towards that path, the more likely you are to actually get to where you're looking to get to. In other words, what you measure, you can manage, and that's part of this coaching mindset. So, and that mindset's relevant wherever stage of life you're actually at. So, on the chart there, you'll see where we've mapped out some key events that occur typically in various people's lives at different ages, but they tend to follow the same process for most people. So when you're starting out in what we call our wealth essentials package for our young up-and-comers, savings plans, making sure that your loans are in the appropriate way, and starting to build up your super and protecting your wealth through insurance, etc., is part of a key component. Then perhaps you end up with being married, looking for first homes. Then effectively you become what we call a wealth accelerator, typically 35 to 50. It says 40 on the slide there, but hey, I've got 50's like the new 40, at least that's what I keep telling myself. So effectively there's basically you're focusing on debt management, some investment planning, and then ultimately when you're looking post the 50-year age, well then you're starting to make sure that you're providing for your retirement and you're making sure that you've got an income to live off when time comes. So the concepts that we're talking about here and the ability to set a plan is relevant wherever you are on that particular curve, whether you're starting at the base end or whether you're more moving towards the last or the later stages in the wealth preserver section. Wherever you sit, the principles that we're talking about tonight are absolutely still relevant. So you may be starting out and people and some interesting components there, and if you are starting out and you're starting right now, well then setting your short and long-term goals is absolutely critical. And there's some stats that were released by one of the Australian government in a recent report. And if you're single, and I'm going to read from the notes here in front of me, age 35 or under, the average they on average spend $849 per week, which equates to $44,000 per annum. So if you can be smarter than that, or if you look at ways that you perhaps can mitigate some of those savings, well, that can open up opportunities to build your savings, build your cash flow, which can then start to set a foundation future for where you need to go. Whether you want to do some travel, or whether you're looking for future career breaks, or whether you're looking to pay off some debt, maybe some study debt that you've already accumulated. But the key element is to basically start having that proper plan and those budgets and disciplines in the first place as soon as you can. Alternatively, you might be moving to the stage in life where you're raising a family, and typically we see people in this area juggling career, family responsibilities. They'll be working pretty hard. They may well be time poor. They'll be starting to look at, okay, well, home investments, or basically perhaps it might be even a second home, or needing to expand the size of the property to meet their family choices. And they're starting also to build their investment portfolio. Again, the disciplines that working out how much money you need, how much money you can afford to invest in a property, covering school costs, which is extraordinary. So for a child born in 2018, again, to quote some of the statistics that have been released in some of the education reports, it costs an average of $66,000 to send a child from kindergarten to year 12. So if you've got 2 or 3 children, there's a substantial investment that needs to be factored in and basically budgeted for and allowed for as part of your financial plan, because mind you, this is for a public school, this is not private school. Private school education can be infinitely more expensive than the numbers that are quoted there on the slide. So that brings us to today, is to where we sit. And before we start setting investment goals, it's worth taking a moment, and this, if you've got your pen out there now, you can start considering this, is to basically take a moment to think, okay, where do you sit now? And where would you like, or what would you like to be? And where would you like the next step to be? So are you actually achieving where you are in terms of your workplace? Is there goals that you have to expand your family? Are you looking to upsize your home? Do you have enough to build a comfortable retirement? Do you actually even know what you think you're going to need for a comfortable retirement? So all of these questions are valid questions and are absolutely necessary for you to sit there and consider in your own circumstance, because there are no right or wrong answers. It's what you're comfortable with, what your goals are looking to achieve. Because once you've considered those, then you can start making choices with some disciplines, with some support that help take that next step. So, and that's really where tonight leads us into, is some of the key strategies, and we've highlighted 10 strategies that can help you achieve your goals and help you get to where you'd like to get to. So before I go through each of the individual strategies, in fact, Christine's going to talk about some of those. it's important to basically consider where you'd like to be. So if you revisit where you were in terms of your life curve and what you see as moving forward, what you're going to need to address, then when we start talking these strategies, you consider how some of these strategies can actually help you individually as we're going through. So the first strategy we see there is setting your goals. And with that component, I'd like to hand over to Christine to perhaps talk us through the first strategy in setting your goals. Christine.
Yeah, thanks, David. So you can see we've broken it down into short-term, medium and long-term. And that's really important in terms of your savings and working out what type of time frames you're going to save over. So short-term would be something you might need in the next couple of years. So it could be, to buy a car, do some travel. So it could be something that's maybe 1, 2, even 3 years. And then the medium term is probably looking 3 years plus. And that could be looking to buy a home, as David mentioned, starting a family, go back to study. So it could be something that's, say, in the 3 to 5 year time frame. The longer term, we're looking at, say, 5 years plus. So that's something you really need to look at longer term investment for. Could be relocating, looking at trying to pay down your mortgage, and obviously very long term is making sure you've got enough capital to fund a comfortable retirement, which is different to everybody depending on how much is comfortable to you and how much you need. So that's really what we look for in terms of setting some financial goals.
Yeah, so our next strategy, Christine, talk about managing debt. So please give us a rundown.
Yes. So the first thing to do is actually to write down all the debts that you have, because where we look at debts is we look at what's good debt, what's bad debt. To us, bad debt, and you can see the scissors there, is the credit card debt. That's the debt that you can't pay off. If you can't pay your credit card off in full each month, that's, to us, that's considered bad debt. High interest rate debt, so those types of debts where really the interest rates, they need to be prioritised. So we have a point there we're prioritising from highest to lowest, so you'd want to try and get the highest rate debt paid off first. And also we look at non-deductible debt, which would be your home loan debt, also trying to accelerate the rate of repayment of that. Spending within your means, very important. I mentioned about Afterpay, I'm not sure how everyone feels like that, but as long as you've got a capacity to be able to pay that debt, don't actually expend more than you can afford to. That should be within your budget.
Yeah, so if we're working hard to consolidate and retire debt on the one hand, it doesn't make a lot of sense if we're building up debt on the other side of the fence, because effectively we're not living to what our budget said we were going to.
That's right. We've got to keep it within our budget. Yeah, unless there was some other change to circumstances, like upgrading your home, but that should also be in the revised budget.
Yeah, correct. So, so basically managing debt, as Christine's already mentioned, the difference between good debt and bad debt. From a tax planning point of view, good debt is tax deductible debt. From a bad debt point of view, that would be typically the home loan. So we're always looking to make the most out of the tax man opportunities wherever we possibly can. So that's managing debt's a key element to most people through their financial lives. So the third strategy that we talk about doing is the difference between saving and investing. Christine.
Yeah. So where we look at the difference between the two, saving is short term. Okay, so saving is something which you put money away for those shorter term goals. Readily accessible for those short-term goals, and also have a bit of a contingency fund there. It's considered low risk. Usually, you're looking at cash and, maybe term deposits, but something you put aside to access in the short term. Where we see investing as a longer term prospect, that's where you meet those medium to longer term goals, and you're really looking to build your wealth. Your time frame is longer term, for that reason, you might actually be prepared to take a greater risk with your investment because you don't need to access those money in the short term, and you're looking for a greater return on your investment. So you might be looking to something that's going to earn a higher yield and provide that long-term growth.
Yeah, so typically short-term goals would be cash orientated, targeting short-term goals, and if you need to invest, then that's what's required to meet typically your medium and long-term goals. So
that's right.
Excellent, thank you, Christine. Strategy 4, or the next strategy, talks about building your savings plan. It's good discipline, which basically is the cornerstone to where all the next steps. So, Christine.
Yes, so working out your budget then, we've worked out how much you actually need to save. And the reason we say pay yourself first is because that's the money that we actually want you to put aside. Pay that first, and then what's left over, which is part of your budget, is the amount that you can spend. So we actually want you to put the money aside for the savings first, and what you have retained for your budget is what you live in. And we don't really want you to touch that savings. It was put away for a specific purpose. You would set that up, and the plan is not to touch that unless you've actually achieved your goal and you've saved that money and you've met it to achieve that goal. But building that savings plan is vital. You can do it from either an auto transfer, or you could even ask your employer to deduct it from your salary and have it put away into a separate account, which you don't touch unless you actually have to. Yeah,
there's a lot of smart apps and technology that are actually out there nowadays that can help people stay on track with their budgets better than what they ever have been before. We use some of those tools in our financial coaching clubs, if you like, that we're actually working with clients and working with groups of typically wealth accumulators building up their stocks and their investment plans. So it is something that we work constructively with, helping particularly young people grow and build their retirement nest egg. So absolutely tools out there in this modern world that can make this budgeting process and tracking where you're up to a budget fairly or very efficient. So that leads us to our probably my favourite strategy of a lot, and that's invest early.
Yeah, so this slide actually shows us about the benefit of compounding returns. So the example is where they invested $10,000 and had a simple interest where you don't reinvest the interest from the investment, where you compare it to a compounding interest where you reinvest that interest every year, and you can see as you continue to compound that interest, the difference between the investment was $26,000 if you didn't reinvest compared to $46,000 odd dollars if you continue to reinvest that over a period of time.
Yeah, so they call compounding the eighth wonder of the world, and that's effectively where that sits. So basically what it just means is if you're setting aside and you've got the discipline to start saving and properly investing in whatever asset class is appropriate to what you're investing in or what you're comfortable with the risk with, if you leave that money and then reinvest the earnings, that's going to basically make a huge difference at the end of the day to the investment that you receive. And in this case, it's almost doubled in that 20-year time frame. So effectively, the secret to this is to have the discipline to basically not only invest, but to let the earnings reinvest those to make sure that they get the right outcome. So really a really powerful strategy. And the longer that you're in the game and you're doing this, the better you are. So effectively, if you're a younger person in your 20s, these things have an infinitely stronger power to actually add great retirement outcomes or great goal outcomes for yourselves, as opposed to even us older people in our 50s. We still have a life expectancy, which mean that we're still going to be looking for decades worth of investment returns. So it's still relevant for us people who are the closer end or more aged end of the process. So basically, the strategy is always relevant no matter where you sit in that game and that life cycle. So our next strategy that we wanted to consider is basically considering and defining your risk profile. Christina.
Yeah, so you can see on the chart there, it starts right down at the defensive end, which is around your cash and your fixed interest. And so this would be for your short-term goals. So something that you're only needing access to in the relatively short, maybe 1 to 3 year time frame. Where it goes to, the balance is somewhere in the middle, so that's becoming more of a medium-term time frame. And then those assets such as properties and shares are the longer-term time frame, those ones that you're doing actually an investment for. So that would be, 5 years plus to provide long-term growth. However, it does actually mean a potential for higher risk. So that is why you need to be invested for the longer term. So where it fits for you in defining your own risk profile is where you feel comfortable with and the time frame that you're looking to invest for.
Excellent.
Yeah.
In our next slide there, I think we consider the risk profile. We're going to touch base a little bit more greater depth about risk and where it sits.
Yes. So your appetite for risk. Again, assessing where you are in your lifestyle and what your financial goals are on your time frame is quite relevant. The other thing is about your own investment knowledge. So it depends on how much experience you might have with investment, if you've ever done investment before, what kind of education you've had around investment. It might mean that you start out in determining a risk profile that you're moderate to start with, that you don't want to take too much risk to start your investment process. But as you grow and learn and understand and get more educated about the the types of investments and how they all work, and your investment knowledge increases, you might feel more comfortable over time moving to more growth type of investments.
Yeah, so typically we see someone start a lot more conservatively and as they become more educated and as they become more familiar with the process, they gain confidence and then are happy to invest further. But I suppose if your lifestyle goals are such that you need to be more fairly aggressive to achieve them, in other words, if you need to be looking for very strong performance, then necessarily you're going to have to take more risks with the portfolio, so it means you're more likely to be aggressive. And I know with some of our, particularly with our up-and-coming investor clients, and we're working closely with in our coaching side of things in the financial sector, with part of what the program we run with is actually making sure that there are independent experts from various fields who come and inform the groups as to what they see and provide insight, so people are more skilled and more able to invest in a more sophisticated basis. So basically, your level of investment knowledge is always growing. It will continue to improve and change over time. And in some cases, as you move further, as you become more of a retiree style investor, then it may well be that you become a little bit less aggressive with your investment style, because basically you want to make sure that you've got a greater degree of certainty because you've already done some of the hard work. So risk does change depending upon what you need to do and how quickly you need to achieve it.
Yeah, it sort of goes through those life cycles.
It follows. Yeah, so basically it does change and move over time, and it's something that should be properly considered at all points. So, and by leads nicely into our next slide is basically making sure that we mitigate risk where we can and we spread risk by diversifying. So, Christine, tell us a bit about this strategy.
Yes, so we were talking about the risks and the different risk profiles. So what we would see with the cash, that would be for for the short-term needs, for maybe a savings buffer there, but for relatively short-term. Your fixed interest investments would be to provide an income, so it might be a slightly more longer-term, maybe 2 to 3 years. So it's still relatively conservative. and then the shares and the property are the long-term investments. So when we say about diversification, it could be that you have exposure to all those different sectors to provide both some income but also long-term capital growth, but within that risk profile that you feel comfortable with.
And in our portfolios, we make sure that in most cases that you've got a spread of the various asset classes.
Yep.
So we're not putting all our eggs in the one basket. We are also spreading our risk amongst the various asset classes. But typically, I think there's another level of diversification that we look to factor in at the same time. And on this slide, I think we talk about not only our investments, but perhaps our the managers and who's managing the investments in each one of those categories. So just as we wouldn't invest in one single asset class, we'd also make sure that we not have just the one person managing that, nor will we necessarily just put it in the one structure. So if we've got different asset managers as well as potentially different structures, some in super, some outside super, then again we're diversifying some of that risk.
That's right.
Okay, so basically, and that's where that slide there just mentions that amongst the various classes of assets inside each of those, which is what we've just outlined. So the next strategy that we're going to talk about, Christine, is probably one that's not for the faint-hearted, and that's gearing, and it's one that we need to approach with a great degree of caution.
That's right, David. So there's some advantages and disadvantages of gearing. I mean, the advantages really is that it allows you to invest a greater amount, whether it be into shares, whether it be into an investment property. It gives you a larger amount of investment by borrowing, which can potentially give you higher returns. It can allow you to diversify over a range of different investments, and it has the tax benefits of being able to claim the interest cost as a tax deduction. And if it's shares, you might get some benefits there from Australian shares. But on the flip side, on the disadvantage, if your investment performs poorly, you've got a larger potential for loss. You've still got to pay back the loan. You've got a risk of the debt spiralling if you can't afford to meet that loan obligation, particularly if you've got to sell investments. And a margin call is where it's in relates to shares where you've actually borrowed against the value of the shares. And the risk with that is that you either have to sell down those shares, potentially at a very poor price, or put more of your own cash in there. So it has some great advantages to accelerate your wealth, but on the flip side, it can actually create larger losses. So it really depends on what type of investor you are. You really need to be a growth or a high growth investor, and you need to have plenty of serviceability and cash flow to be able to fund a gearing strategy. Yeah,
I think it's fair to say that it's a strategy that we tend to only look to be implementing for a more sophisticated investor that is probably more experienced and understands what happens in the marketplace and potentially the wins and losses as to what can occur. And COVID and the markets have been an interesting case study at present with what's occurred since March, through no single fault of any individual itself, but ultimately the markets have been through extreme volatility, and perhaps we haven't seen the end of that volatility yet. So again, it's a strategy that we need to be very cautious of, but can add significant value in the right circumstances. So we've just covered off on gearing, and our next strategy is important and critical, as we need to make sure that we're investing in the right place. Tell us a little bit more about that, Christine.
Yes, so the slide here actually shows an example where you invested outside of super or inside of super. So David, I think
I've got some key numbers in terms of that. So basically, in these assumptions, basically we're talking about investing before tax of $5,000 on a regular basis, and basically if we've assumed the pre-tax return of a bit over 7%. And after fees of about and tax of about 5.08%. So Basically, what this scenario envisages is regular superannuation contributions or regular savings that have built up outside super as opposed to inside super, and then ultimately drawing off that income when that person hits retirement age at an amount of $30,000. And what you can see quite clearly from the slide there is basically there's a significant difference of, to be exact, $156,112. Basically, that means if you save that money on a regular basis inside super because you're utilising the tax concessions, then at the end of the day, you are going to end up with a significantly larger sum that can effectively fund your retirement and basically allow you to be paid a lump sum or a pension, if you like, for a further 6 years when retirement comes. So we'd always talk in terms of our presentations about the smart strategy and the right structure, or the smart structure. Superannuation is obviously a key component to that smart structure. So, and I didn't say at the outset, but the person in this scenario was only at the 31% tax, the 31.5% tax bracket. If we used a higher income earner, then the difference between those two strategies would be even more marked.
That's right.
So effectively, this is, if you like, a conservative difference, not a big difference, just a conservative difference.
Yeah.
So along the lines, we talked about, okay, investing in the right place, and superannuation is obviously a strong consideration. Let's talk about a little bit more about investment in super with our next slide.
Yes.
Christine, you want to touch base on this one?
Yep. So I guess I'm going back to the last slide. It does depend on whether you do need access to your capital. So obviously, when you put your money into superannuation, it's preserved. You can't actually tax it to retirement. That's why it gets that concessional tax. And you can see there that the tax on contributions to contribute pre-tax is 15% on tax being contributed, and then the maximum 15% on investment earnings. And the reason we say maximum, because there is some deductions in super, you know, that might come from some expenses, and also there can be some tax effective, you know, things from Australian shares. So effectively, you can even bring that earnings tax down lower. But the major advantage here is that when you get to age 60 and you're retired, there's no tax on any withdrawals, and there's actually no tax on any earnings once you start a pension. So there's no more favourable tax treatment that you can get than inside the superannuation environment. Yeah,
effectively, I quite often say in a lot of my conversations with our clients, it's basically superannuation is effectively our own legal tax haven. So effectively, you can build up sizable contributions or sizable amounts inside superannuation, which are then earning substantial income and paying no tax on that income, and you can draw off that income and live off it, and again pay no tax on those drawings, no matter what size drawings you make. So it is really a powerful strategy when you can compare it to, if you're investing in your own name, then you could be paying up to 47% tax. So if you're already in a strong financial position and you're getting more income and trying to invest that in your own name, then clearly there's a more tax effective way to do it, and that's to focus in on superannuation. So
yeah, even for young people, David, isn't it?
Yeah, absolutely.
Yeah, you just put aside a small part of your salary, and we talked about that compounding return earlier, putting aside a little bit extra of your pay. You know, you won't miss it once you start that, and it makes a big difference over the long term.
It does. So basically, where we sit, no matter where you are in your life cycle at the moment, basically your future just won't take care of itself. So it's absolutely important to plan and take the necessary steps that you need to achieve your goals. There's strategies here, and we're going to talk about a little bit that further in a moment, but you can actually make some changes and implement some changes there now to actually let you achieve your goals. Recent study from the Financial Planning Association said that there was 3 main obstacles to people living the dream, or living the dream as they see it. 48% said basically low bank balance. In other words, they just didn't have enough cash. 28% said they didn't have enough time, and 26% said they had too much debt. So if you're starting to plan and use these concepts that we've already talked about, well, then you can be in a position where you're not finding these same obstacles if you take action to avoid them there now. So having considered where we are today, and following on from tonight's presentation, very shortly you'll receive a feedback form. On that feedback form, you'll have the opportunity to provide some feedback. Please do. We benefit and we improve these presentations on a regular basis on the basis of the feedback we have, and we've had a substantial number who have attended tonight, so we really would appreciate your feedback. But on that feedback form, you'll also have the opportunity to nominate a specific time where you'll be able to consider this action plan that I'm going to ask you to make for yourselves now, and discuss that and review that with one of our key financial experts, financial coaches, if you like. So on the slide there, you'll see the 6 steps that you can take. In other words, 1, think about what you want to achieve. 2, what are your goals? 3, create that savings or debt management plan. 4, understand risk and where you think you can improve or where you need to improve your education levels perhaps. And 5, take that next step and invest in an appropriate asset class that suits your priority. And 6 is seek professional support, and we're running coaching support groups particularly for young people who are focusing on their financial future on a cost-effective basis to help them achieve these sorts of things, because the cost of financial advice is not cheap. Compliance is expensive, but there are opportunities that you can take that can help people self-help, which is what financial coaching is all about. So that was the next opportunity that I've just outlined. So basically, take the opportunity, consider how these strategies can be applied to your own circumstances, and please complete that feedback form that's there. So the group, we haven't had a lot of the questions there tonight, because probably we've been more of a scenario based where we're telling you information. If there's any questions at all that the group has, now would be a great opportunity, and I can deal with those as they come up. Excellent. So on behalf of the team at AdviceCo, thank you very much for your participation tonight. Again, please take the time for the feedback. We do appreciate it and we do value it. Special sing out to Ed, who I believe is on part of this call. Ed, I hope you're okay and you're back on the mend. We'll make sure that we've got lots of work there for you at the back end of this, so we can cover in. And basically, thank you very much for your attendance tonight, and I look forward to helping you achieve your financial goals when we next catch up. Thank you.